Have you ever logged into your brokerage account and seen that you suddenly have fewer shares of a stock, but the total value of your investment is roughly the same? It's a confusing moment for sure, and you might be looking at a reverse stock split. But what exactly is that? Don't worry, we're going to break it down in simple terms. A reverse stock split is essentially the opposite of a regular stock split. Instead of a company increasing the number of shares and decreasing the price per share, it does the reverse. The company reduces the number of its outstanding shares in the market, which in turn increases the price of each individual share. Let's use an easy example. Imagine you own 100 shares of a company, and each share is trading at $1. Your total investment is $100. Now, let's say the company announces a 1-for-10 reverse stock split. After the split, you will own only 10 shares instead of 100. But, and this is the key part, the price of each share will increase tenfold to $10. So, your 10 shares are now worth $10 each, and your total investment is still $100. In theory, the total market value of your holding doesn't change at the moment of the split. So why would a company do this? It sounds like just shuffling numbers around, right? Well, there are a few strategic reasons. One of the most common is to boost a low stock price. Many major stock exchanges, like the NYSE and NASDAQ, have minimum price requirements for listed companies. If a stock's price falls below a certain threshold, typically $1 for an extended period, it risks being delisted. A delisting can be a huge blow to a company's prestige and makes it much harder to attract investors. A reverse stock split is a quick way to get that share price back up above the minimum requirement and stay on the exchange. Another reason is to improve the company's image. A stock trading for pennies can be perceived as being in trouble or of low quality, which can scare away institutional investors and large funds. Many of these big players have rules that prevent them from investing in so-called penny stocks. By increasing the share price, the company can look more stable and appealing to a broader range of serious investors. It's a bit like putting a fresh coat of paint on a house to improve its curb appeal. However, it's crucial to understand what a reverse stock split is not. It does not fundamentally change the company's value. The company's market capitalization, which is the total value of all its shares, remains the same immediately after the split. It doesn't magically solve the underlying business problems that may have caused the stock price to drop in the first place. Think of it like this. Cutting a pizza into 4 large slices instead of 8 small ones doesn't give you more pizza. You still have the same amount of pizza. Because of this, a reverse stock split can sometimes be seen as a red flag by investors. It's often a sign that a company might be struggling. While the goal is to attract new investors, the action itself can signal distress, and the stock price might continue to decline after the split if the company's performance doesn't improve. So if you see a company you've invested in announce a reverse split, it's a good time to do some extra research and understand the health of the business. Is management turning things around, or is this just a temporary fix? In summary, a reverse stock split consolidates the number of existing shares into fewer, higher-priced shares. It's a tool companies use to meet exchange listing requirements and improve their corporate image, while it doesn't change the immediate value of your investment. It can be an important signal about the company's situation. Always look deeper into the why behind the split. I hope this helps demystify reverse stock splits for you. If you found this explanation useful, please give this video a thumbs up and don't forget to subscribe for more financial insights. Thanks for watching, and see you in the next video.